All right, good afternoon. For those that don't know me, we have several guests. I'm Brad Bruce, one of the founders of mForce Capital, and want to welcome you to our mid-year market review with Marion Bartels. Today's kind of an interesting day for us. We are, as a new firm, we are 4 years old today. So we're celebrating a journey that's been fun and exciting and a lot of work. And it's very appropriate that we have Marianne on with us today. Good afternoon, Marianne.
Hi, good afternoon, and congratulations. That's so exciting.
Well, thank you, thank you. Well, on behalf of Jonathan Connor and Ann Connor from our Dallas office, Joanna and Lindsay from our Hot Springs Village office, of course, Matt and DJ and April and Cheryl and Grant from our Fort Worth. We also want to welcome for the first time Marianne and Rachel from our North Carolina office. And so we have Marianne, we have clients from across the globe today with us. And we're excited to have everybody join us. Cheryl, are you on the presenters list today?
I didn't know that I was. Hello.
Well, welcome. This is Cheryl McCarson. She is one of our lead assistants at Fort Worth. And Cheryl, you may need to go back into a participant stage versus a presenter stage, okay? All right, here we go. All right, Marianne, I've been following your research for the last 30 years. And when you said more than once that we have a bucking bull ahead of us, it's been kind of an amazing ride this year. I know I was looking at just some brief numbers, and if you started on January 1 and went away until yesterday, you'd say, oh, it's a very kind of normal year. You know, the markets are up, the S&P is up about 4.2%. But as you know, right, we have had quite a ride where in February the 19th, the market was up about 4.4%. And then by March 8th, it was down about 14.5%. So about a 19.5% ride down. And since that time, we're up 23% back to 4.4. So with that setting the stage, what can we expect going forward?
Well, I'm still bullish, but what I thought I would do, because we had recent events in the Middle East,
Yes.
explain why the markets are up, even though missiles were flying in the air and bombs were going off. You wouldn't think in all the world that crude oil prices on the day of the bombing would collapse. And crude oil prices went down, about 17%. On the US actually bombing the Middle East. It was quite shocking, not what I would expect. So let me kind of walk through that, and then I'm going to kind of walk through where we see markets currently and where we see them going forward. But if you have to leave us early, we still remain very bullish. And what is driving this bullishness is that we are going to completely alter how we function, how we work. This is all about artificial intelligence. It's about robotics. It's about blockchain. It's about crypto. This is the internet on steroids. And the amount of money and infrastructure that has to be built is driving corporate profits, which is going to drive markets higher, but it's going to be somewhat concentrated, and it's basically tech related. It's also in industrials because of the infrastructure. Because we're going to be spending so much money now globally on aerospace and defense, that industry is going to continue to boom, but it's really tech related. Defense has always been technology, and our banks are good. And we just got news today that it's very likely that the Federal Reserve is going to pass a bill that's going to allow banks to have more treasuries on its balance sheet. And that's actually very bullish. So the outlook remains very positive for equity assets, not just here in the United States, but now globally. But let me start off. I'm going to start sharing my screen, and we're just going to take a look at crude oil to explain why markets went up. And whenever we have international events, particularly war, and unfortunately the first one we had to talk about was Russia and Ukraine, we didn't think it would have a negative impact on markets. And the reason why is it was not going to impact oil supplies. When it really comes to war, and if it's not on US soil, it's about what happens to corporate profits. And if corporate profits are not impacted, then it doesn't really matter. Because it's the Middle East, oil is the most important factor in the decision. And if oil supplies were disrupted, we would see oil skyrocket. But we haven't seen that because nothing has impacted oil or oil supplies negatively. So we saw oil prices go up and literally come right back down, but never made a major breakout. And oil prices are still on a decline. Now, the summer months are actually tend to be very bullish for oil, right? Because consumers drive, go on vacation. But we really right now don't see oil going above 80. What we said is if we got above 86, so if we started moving up into this area, the risk is 100 to 125, but we didn't even have that. So with oil prices coming down so dramatically, markets have rallied. NASDAQ has actually, on an intraday basis, and I think a closing basis, made a new high. S&P has not done that. And I do think later this summer months, we will be at new highs. Markets are a little overbought in here, so I still think once we close the month and the quarter, we could have a little bit of a correction. But I think it's very modest. We've been calling maybe for a 5 to 7% pullback, nothing major. And that for the markets to continue to march higher into the end of the year. So now I'm going to share with you my presentation. We can get that a little bigger for you. There. So we've had tariffs, we've had Doge, we've had a lot of market volatility. I could even put war there, but that's kind of questionable. For now, I don't think that is going to be a factor, meaning what's going on in the Middle East. So as Brad pointed out, we've had extreme volatility. The market was looking for tariffs, but not the kind of tariffs that Trump originally announced, which is why the markets went down 20%. But as Trump does, he negotiates. And when he started to dial back on the tariffs, the markets started easing up. And because the markets are basically believe that Trump is not trying to destroy the capital markets, that they've been able to rally and go to record highs, focusing on the fundamentals that are driving the market. When I look at the markets, what my thesis has been and continues to be is that we're in a secular bull market. I like to take a bigger picture. I feel that the market, and whether you're looking at CNBC, Bloomberg, Fox, you can get very good news on markets, but I feel that we've gotten very short-term oriented, very trading oriented. Even most of the research I look at today is very short-term. And it's okay to look short-term. I look short-term. But the real point for an investor is to really see where we are in the long-term cycle. You're not traders, you're investors. And markets have long cycles. They're called secular bulls and secular bears. They can last 15 to 20 years. And I've kind of outlined this. This is the Dow Jones Industrial Average. And you'll see times where we trade sideways. That's a secular bear. We tend to have very big down periods. Markets have severe corrections. Then we go into a long uptrend. Now we'll have bear markets. We'll go down 20 or 30%, but we recover and go on to record all-time highs. Again, secular bear, secular bull, secular bear. We're in a secular bull. My estimate is that we're going to stay in the secular bull to the end of the decade, out to about 2029, 2030. And then the likelihood is we're going to go into another secular bear market. And that's not to have investors panic. It means the leadership that led us up will have a massive correction, but new leadership will come. So it's about positioning the portfolio correctly, but not to panic. And many of you have probably lived through these cycles already.
And we're seeing something of rotation a bit going on right now, right? We've seen some of the dividend players, some of the international markets. What's your take on that?
So dividends, because we have a population, the baby boomers moving that are in retirement, moving into retirement, dividends are always going to play an important role in a portfolio. In terms of what was the other, I'm sorry, the other point you made?
Yeah, so we've seen more of the.
Oh, international markets. And I'm going to talk about the international markets towards the end.
Okay.
I think it's the first time in my career that global markets are in a secular bull market. Now, the international markets are early. What I learned when my aunt trained me many, many decades ago is before your leadership ends, new leadership starts coming. And I think part of this new leadership is the international markets. And I think part of why the international markets are going to do well is they're going to spend money. You've seen that with Germany already announcing almost €1 trillion on infrastructure and defense. You saw with NATO today, they're going to up their percentage on defense. That's spending. That's bullish. When you spend money, risk assets go up. But where the other spend, and really what I think is driving this global secular bull market, is artificial intelligence and robotics. It's also blockchain and crypto, but the real capital spend right now is building out data centers, right? We've been big believers that semiconductors are the leadership, and they are, because you can't have a data center without a chip, and you need hardware and you need software, but the highest demand will be for chips. So let me just take a little bit of a step back so you can understand the magnitude of this technology evolution that's really occurring. In the 1500s, the technology was the sundial. We were an agricultural-based economy, and the sun was the most important component in driving that ecosystem, that economic system. And we didn't change that system until we created the steam engine. Now you have to, we lost a lot of farming jobs, but you created a lot of industrial jobs. And we stayed industrial for 300 years before we really started going digital. I marked digital at 2000 because it's a nice round number. It really started in the 1990s. One would argue it even started in the 80s when we started to see even singular computers move into the workforce. And as we connected computers and created networks, it started adding productivity enhancements. Then we added the internet. And this is where we started the digital revolution. You're at ground zero in terms of computers and the internet. AI is going to bring us up into the next generation of technology. And if we're correct, tech, or the digital era, is going to last for hundreds of years. So the story I always tell is about Star Trek. And I really believe this. If you follow the path of Star Trek, you will understand the path of technology. What used to be our fantasy is our reality. The other program you can watch is the Jetsons. So let's start with Star Trek. Kirk started with a flip phone. That was outside of the big first phone we had, down to the consumer level where it became mass produced, was a flip phone. Your communication officer always had a cordless thing in their ear talking. I think now you see everybody walking around with a thing in their ear. I know a lot of times when I'm walking, I think a person's talking to me, but they're really talking to their earpiece. If you look at the consoles on Star Trek The Next Generation, they're iPads. Data, the robot, we're going to have robots. Robots are already being built, and it's more advanced right now in China than it is here. We have driverless cars. This is real. I was in San Francisco. There's driverless cars. I was in LA. Driverless cars. People are using them. What was really weird for me when I was in LA is this cart went across this major road. It did have a flag on it. They're doing food deliveries on these little carts that just are robotic. China already has flying cars. So Yes, we're just starting to have driverless cars. China is already advanced in flying people in cars. We will be moving in that direction as well. Think of the Jetsons with robots. Meta is doing virtual reality, the headsets. Well, that's the hologram. We have not done Beam Me Up Scotty yet. That's going to take probably quantum computing before we even get there. That takes an awful lot of compute power to dematerialize and rematerialize something. But if you follow these programs, you can see how step by step we're developing it. And if you're like me and didn't grow up with technology, it's kind of hard to adapt and realize the world. But the younger generation that grew up on technology, this is their norm. This is being built out not for the baby boomer generation. This is being built out for Gen Xers and the ones alphas, all the ones that are coming up will easily adapt, particularly to the crypto market, which we'll talk about. So when you think about companies, the survival of companies, if they don't adapt technology, they're going to fail. ChatGPT, Perplexity, Anthropic, OpenAI, DeepSeek are just the first early phases. And Bank of America just happened to release a report today that said the spend going out to the end of the decade, just trying to build out these data center infrastructures, is going to be at least $1 trillion. The other important thing that they noted is every country is going to want their own infrastructure, their own language, their own program. Businesses are not going to put their business out on an open source AI like ChatGPT. They have to build all of that internally. Now, banks have been doing it. If you happen to have a Bank of America app, Erica will already do things for you. That's an AI agent. And we will start having AI agents. It'll be me in a hologram talking to you about how you want to build out your vacation. And that AI agent you can talk to, I'm sure you can type too, will be able to assist you in doing things. So the whole point is what's driving earnings and revenue is this whole new world of technology. And that's what I argued even during the tariffs. I said, we stopped talking about AI. Everything became tariffs. And I'm like, AI is still moving. Companies were still announcing that they were still building. And now that we're kind of moving sort of past the tariffs, we're not there. Tariffs are going to come back up again. But you're hearing more and more about this AI build out. And I think you're going to be hearing about that for the next several years. AI adoption is now starting to take place, and you're going to start seeing this go vertical. And when you look at how fast the market adopted to OpenAI, ChatGPT, it's the fastest adoption of technology ever by the consumer. And again, what drives markets? When you have events that occur, and the reason why when tariffs came out the way they did, why the market went down is if those tariffs were implemented in the way that they were described, corporate profits would have gone down. And that's why markets went down. Markets discount 6 months ahead. They don't wait around. They're trying to predict where things are going. Now that the tariffs have somewhat been dialed back and are more understood in terms of the impact to corporate earnings, markets have been able to come back again. And when we looked at earnings the previous quarter, in the first quarter, earnings grew by 12%. That's a good growth rate. Now, they're still concentrated. They're not broad-based, but they're still growing. What's really interesting is because now we're coming to the middle of the year, and I said that markets discount 6 months ahead. We're going to start pricing in what corporate earnings are in 2026. And if you look at the earnings forecast now going into 2026, They're for corporate profits to grow around 14%. And that's bullish. We think productivity enhancement's going to keep margins high as well. And that's important. So let's look at first quarter. If you look at the Magnificent Seven, which are tech and tech related, that's where the bulk of the earnings occurred. The rest of the market is not growing as fast. And yes, so it's concentrated, but I'm not as concerned about it because these companies are mature companies. They're not even early stage growth companies. These are mature companies with phenomenal balance sheets, a ton of cash, not a lot of debt. So they're fundamentally sound. And you really, in an environment like this, have scarcity of earnings. Because even when we look at who's producing, since it's so concentrated, it's called scarce earnings, not abundant. When you have scarcity of earnings, you're in a growth cycle. When all companies are earning money and you don't have scarcity, it's a value cycle. We're still in a growth cycle. So even though corporate profits are growing nicely, they're very concentrated, and that's keeping the growth cycle. That's not to say that some value companies are not attractive. We like the banks. If the Fed signs this new piece of legislation, this is going to be very positive for the banks. There's pockets of industrials that are considered value. So I don't think value is dead. I think you have to just be very selective in what you own in value. Energy is value. Unfortunately, with crude oil prices going down, stock prices don't go up. We need crude prices to go up in order to have energy stocks go up. But the big energy companies, great balance sheet, great cash flow, and I would argue are probably very undervalued. I think energy stocks will do very well in the next decade. So it's not that I'm negative longer term. They're just not growing as fast as the tech companies, so the market doesn't want to own them. And the only reason why they would own them is if energy prices went up dramatically. But there is a pocket that the market likes, and that's in LNG. So if you look at LNG stocks or gas-related stocks, they're performing better. So there is a pocket within energy right now that we think can perform well. This is an old index called FANG. F was for Facebook, which is now renamed Meta. You had Apple, Netflix, and Google, and there's a few other companies in here. But I still like to look at it. And it's already broken out to record all-time highs. This is already back in the middle of June. You already saw these stocks as a group making new highs. Now, the chart on the bottom is that FANG index divided by the S&P. When that is rising, it means it's beating the market. And that tells you it's leadership in the market. And we broke out and we're sustaining that. This is part of the leadership within the marketplace. The true leader, I believe, is semiconductors. But I wanted to give you a broader overview that tech and tech related is still the leadership within the marketplace. The S&P 500 had a major breakout and started a secular bull market in 2013. And we've had periods of consolidation. In fact, this pattern that I've kind of drawn for you, it looks like a staircase. We call it step of stairs. So you get periods where you go up, you consolidate, you go up, you consolidate, you go up. We've just been now in a period of consolidation. I believe we're going to break out of that. And my target is for the S&P to get to 7,200. When I came into the year, I thought we could get to 7,200 by the end of this year. That might be a little bit of a stretch, but I still believe it's a very valid target and one that will be achieved, but it might be next year, not this year. Now, we found this fascinating. The last time Trump was in office, he was elected in 17, but we looked at the market in 18 and overlaid this market cycle with 2018, and it's almost identical, which is it's just fascinating. And if we continue to follow this, we should have a little bit of a dip in the market, and then go on and hit new highs in August. So I do think by August we'll be at new highs within the marketplace. Now, what's really different in this cycle, because I've been doing this for 40 years, and what used to happen is about every 4 years, we would have a bear market correction of 20 to 30%, kind of followed the business cycle. This time, we've had 4 bear market corrections, 20% or more, 20 to 30, in an 8-year period. That's extraordinary. And I say, no wonder clients are nervous. If you're seeing this kind of volatility in your portfolio, especially if you're approaching retirement or you're already in retirement, this is a little unnerving, and I can understand that. But every single time we've corrected, we've bounced right back and we've gone on to new highs. As I said, I think we have a few more years in the secular bull market as we're building out this AI, robotic, blockchain, crypto infrastructure. And then markets will trade flat. And that's when I think maybe commodities, parts of the energy part of the market will go into a bull market. And I think the international markets are now in the early stages of a new secular bull market. So for the first time in a long time, I think it will be appropriate to add some international, but I'll get to that again a little bit later. The Atlanta Federal Reserve does an estimate of how the economy is growing. It's a very volatile model. It's not necessarily accurate, but it gets the trend accurate. It has been forecasting that the economy is growing over 3%. I don't care about the number. I just care about the trend. Is the economy growing? And the point is the economy is growing. Why is that important? If your economy grows, companies can make money. It's also the consumer. We're going to talk about the consumer. So this is a very important component. We don't see any recession ahead. We still see the U.S. economy very strong. The yield curve is a predictor of strength or weakness in an economy. And the yield curve has gone positive again. And a lot of people are not talking about that. What does that mean? So when we look at the Treasury curve, short rates should be lower than longer rates. The spread that we're looking here is 2-year and 10. And the 2-year is now lower than the 10-year, which gives you a positive yield curve, which is the way it's supposed to be. But when it inverts, it's because the Federal Reserve has been raising rates, trying to slow down the economy because they think it's growing too fast or it has too much inflation. The market is now flipped, saying now the economy can grow. Interest rates have been trending down, and it's very likely somewhere here, I don't think it'll be July, but somewhere maybe around September, if inflation data is weak enough, possibly July, we'll start seeing the Fed cut rates. But what's very important to remember is the Fed has already cut 100 basis points or 1% from September to December of last year. Monetary policy lags by at least 12 months. So we're going to start to get the impact of the lower rates in September into the back half of the year. That's also another positive stimulus for risk assets, particularly equities. Here we can see core PCE. Most of us look at CPI, but the Fed really looks at core PCE to make its interest rates decisions. And we're already at a 2 handle. So it's not an absolute 2, but we're in the 2s. And their target has been 2%. This is why you're starting to hear some Federal Reserve governors say that we might see some rate cuts. Now, President Trump would like rates to come down because the cost of funding the deficit is very high. And a lot of the funding right now is at the short end of the yield curve. So if those rates can come down, the cost of funding the deficit will come down. This is why President Trump is trying to put so much pressure on Chair Powell to lower rates. But Chair Powell wants to make sure inflation is contained due to the tariffs. And we're probably not going to get a good sense of tariff impact for another month or two. And CPI, which is probably the index that most people look at, is also at a 2 handle. Not X food and energy, it's a little bit higher, X food and energy, but we're in that 2% range. So if we're not seeing inflation really creep up due to the tariffs, the Fed, by the way, a week ago had its meeting. They're forecasting inflation is going to go back up to 3%, which is why they're not willing to cut rates. Going up to 3%, I don't think will be a big negative for markets. Could hit the bond, make a little bit of a bond volatility, but I don't think significant bond volatility, because then we're expecting inflation to come back down. But if we don't see inflation tick up, there's going to be a lot of pressure on the Fed to cut rates. Excuse me. 10-year treasury yields. I know, Brad, I've been saying they'd be going to 2.5 for almost 3 years. One day we will hit 2.5%. I don't think we're going to break above 5%. Right now, this year, I thought we'd be in a range between 5 and 4. We're right now about 4.3. Maybe we creep down to around 4. But I do think the trajectory is for rates to continue to come down. And that's going to be both on the long end and the short end of the curve. In fact, the 2-year is very predictive of what the Fed will do. In fact, it tends to lead the Fed. And that is also saying that rates are going to come down. And what's interesting, you can get to 2%, possibly even lower in the 2-year. Now, this piece of regulation by the Fed, if they allow the banks to take on more treasuries, this is really key, because what Treasury Secretary Bessent wants to accomplish is restructuring how we fund the deficit. Right now, a lot of that paper is at the short end of the curve, and that creates instability in the sense that you can't do long-term projections where rates will be. And I think they're going to restructure how that paper is, meaning they want to go out longer term to have more stability and predictability on the cost of funding the deficit. And if they do that, I think that's going to be extremely bullish. It's going to give, we call them the bond vigilantes, the naysayers, those that are afraid that the dollar's losing its reserve status, a pause. In fact, I'm going to talk about that later on, where we see future demand for treasuries in stable coins. And this is something that's very new that many people don't understand. But there is a demand factor growing from stable coins, particularly from Tether stablecoin, to buy treasuries. The consumer is extremely important to the economy. They provide 70% of GDP. So we're going to look at this consumer in a couple of ways. Now, is there a consumer that's struggling? There is. There's the consumer. There is a consumer that's running paycheck to paycheck. And as prices go up, as the cost of shelter goes up, as the cost of food goes up, as the cost of gasoline is up, right now it's down, but when that goes up, they're struggling. But you can't look at just that demographic. You have to look at the consumer across all metrics. And so we're looking here at real per capita income. So this is adjusted for inflation. How much money does the consumer actually have? Is it growing or contracting? Per capita income is growing. Why? Because wages are going up. Wages are growing, allowing the income of the consumer to go up, which is allowing the consumer to spend, but they're spending selectively. Now, we look at the Bank of America report on the consumer. And if you want to follow this, you can. They give it away free. You can go up to the Bank of America Institute. They write about the consumer every month. And they look at their overall credit card spend. And they've seen a slight slowdown in consumer spending, but nothing significant. As of June, spending is up 4% year on year. Now, there was a front-loaded spend due to the tariffs, where the consumer bought things ahead of the tariffs, anticipating prices of goods going up, including cars. But now we're working that off. And even in working that off, we're still seeing a consumer that has not completely retrenched yet. That's bullish. Another way of looking at the consumer is by looking at disposable personal income. In other words, you take out part of the cost of living. That's still growing. And we look at the savings rate, even though it's a residual number, it's still an important number, and savings is rising. So no matter which way we look at the consumer, we don't see a consumer that's going to have a negative impact on the economy. And so if you have a growing economy, you have a consumer that has the ability to spend, you have markets that have the ability to go up. Now, you're not seeing a lot of reporting on this, but business tax refunds have actually skyrocketed. So the government is not only getting money from tariffs, it's getting money from the consumer, but businesses are also giving the government money. And when we see business tax refunds actually go up, GDP goes up. So that's another positive mark. So I've talked a lot about tech, but another part of the economy that's doing very well is industrials. And this is many of the companies in here make the parts to build out the infrastructure we need, particularly for data centers. Aerospace and defense is in here. I've always said when at war, you own defense stocks. And we still need to replenish a lot of our defense that we've given to Ukraine and to Israel. So there's part of that build. And now you're going to have NATO spend more on defense. And Germany already announced a significant increase. And part of their spend will be on US defense technology. So I think that's going to be also very bullish for industrials. The other part of the puzzle is when I look at tech and industrials, they're called cyclicals. And cyclicals do well in a growing economy. So that's another check mark. The cyclical part of the equity market is rallying, confirming that the market is pricing in stronger economic growth. Now, utilities just used to be for income and defense, but now they're also growth stocks because the demand for electricity is now rising for the first time in 20 years and significantly because the power we need for AI, for blockchain is enormous. So this is a very interesting sector. So now it's not just defense. It's not just for income. It's also now for growth due to needing more power. Healthcare is a sector that I think is undergoing a massive secular shift or change. Now, part of this is coming from the Trump administration. I call healthcare in intensive care. It doesn't mean that there can't be a company or two that does well, but there's going to be a massive overhaul, I think, within this sector. And so it has no growth. It's not where the power of earnings is coming from. Gold had a 12-year breakout and has gone vertical. And it took a while, but finally gold stocks are breaking out. In fact, all metals are breaking. It's silver, it's platinum, it's palladium. And part of that is we need some of these metals for infrastructure. The metal stock, the metal gold mining stocks have just started to perform. And part of the reason they don't perform right away is because many of the companies hedge part of their gold exposure. But if you haven't bought gold and you don't like the vertical up, I think you can now get that exposure in the gold metal stocks. Now, gold is going up for all various different reasons. I think part of it is inflation. Part of it is because central banks are diversifying, particularly China, their reserves. And China's going to be a long-term gold buyer. You're seeing it because of the concern over the U.S. deficit, concern over the US dollar and whether or not it's going to remain a reserve currency. So gold has become a store of value again. And I do like gold. I think it is tracking up towards 4,000, but I think the better performance in the near term is going to actually now come from the gold mining stocks. Aerospace and defense is just in a bull market. I've talked about it, the replenishment for the United States and the growth of defense now in Europe is going to be quite significant. Now, let me talk about global markets. This is the Vanguard Global ETF, and it's breaking out to a record all-time high. Europe, relative to the US, looks like it's trying to break out, and some of the European markets have already broken out. MSCI EFA, which is covers Europe, Australia, parts of Asia, not emerging markets, has broken out to a record all-time high. I think the world is moving into a secular bull market driven by all the spend that's going into all of this new technology. So I do think you can start diversifying. Now, currencies will have an impact on returns. Right now, the world is very underweight US dollar and very overweight non-US. In other words, they're very underweight US assets right now. I do think that's going to flip. I do think they're going to come back and buy US assets and the dollar will rally. So I don't think it's a rush to go into these markets, but I think as you're planning and looking at your asset allocation plan, I think we can start slowly adding international exposure. Now, emerging markets also are looking attractive. China has bottomed. I don't think the world is going to buy China, but they do have some interesting companies in the tech space. And I think that's what's driving their markets. Japan, I believe, has entered a new secular bull market, will become a major, I think, manufacturing hub. And they're also very good at building out robotics. Now, let me talk a little bit here about crypto, because this is really important. So let me go back to Star Trek. Star Trek had a currency. You don't hear about it a lot, but there's two currencies in Star Trek. There's one that's called latinum. It's a metal that's not stable, so they put it in gold. So gold is still a medium of exchange, still a way of paying for things. But they had Federation credits. So let's look at Bitcoin and the blockchain. What is the blockchain? The blockchain is a technology ledger. It's a ledger of debits and credits that gets verified. Well, where does Bitcoin trade? Bitcoin trades on the blockchain and can be used as a credit. Bitcoin is a currency. When you hear about Ethereum, Solana, Chainlink, XRP, that's technology. Ethereum is a platform. Solana is a platform where people put their smart contracts or their programs. Bitcoin will be treated as a currency. The algorithm only allows for 21 million. So it is considered scarce. The other token that you will start hearing about are stable coins. Stable coins, in this case, something like Tether, is actually backed by US assets. So if you buy Bitcoin, it's going to go up and down in value. If you buy Ethereum, Solana, the price volatility is extraordinarily high, extraordinarily high. But if you want to have a digital asset that does not have volatility, you can have a stable coin. So it's like having a dollar, but it trades on the blockchain. Treasury Secretary Bessent has recently come out and has indicated stable coins can grow to the size of 2 trillion, and I've heard higher numbers. Now, why would you use a stable coin? Well, if you're a global business and you want to have payment, but you don't want to have a bunch of different currencies, you can accept stablecoin. I'll give you an example, one I just learned about. Elon Musk has a number of companies, and one of his companies is a satellite company. And he has countries, 180 countries, buying his satellites. But you know how he receives his payment? In stable coins, in dollars. He doesn't have to worry about 180 different ways of getting payment. He gets paid only in stablecoin. Stable coins trade 24/7, 7 days a week. That's the other beauty, is no more banks, no more waiting. I mean, I could pay somebody internationally in seconds, where if I went through a bank, it still takes me days. In fact, the joke is I can take money in a suitcase, fly overseas, and pay somebody faster than a bank can get you paid. Now, if you're a special client, maybe you get an exception, but the average person, it takes a couple of days to get an international transfer done. So there's an infrastructure being built for crypto and for payment. MasterCard has announced that they're building a wallet for stable coins. Now, a stable coin will probably not just be in dollars. Europe will probably have a stable coin for their euro. There'll be a stable coin for yen. My argument has been that the world is going digital. We're not going to have paper and coin anymore. Again, Star Trek. Everything is going digital. There will be a day that your stocks and your bonds trade on the blockchain. That infrastructure is being built out right now. You can buy a money market fund token and get paid, called Benji from Franklin Templeton. JP Morgan just announced that they're going to float a token on the institutional side. Now, this is important because Larry Fink from BlackRock hated Bitcoin, tried to trash it. But when it came to issuing ETFs, they issued a Bitcoin ETF, and now BlackRock has the largest Bitcoin ETF. Jamie Dimon trashed Bitcoin, has trashed crypto. That's the CEO of JP Morgan. And now his company has announced a crypto token that they're going to test on institutional accounts. Now, even Brian Moynihan, the CEO of Bank of America, recently has said, once we have clarity on regulation, we'll go into the crypto market. There's a piece of legislation in Congress that just passed I think it went through the Senate, called the Genius Act. It's not legislation yet, but look for that act to get passed. We are now starting to get legislation in the crypto space. And believe it or not, we're ahead in the AI space. We're behind in the crypto space. We're behind even robotics. China's actually a little bit more advanced, I think, on the robotics side. So I'm not trying to encourage you to necessarily invest in the crypto space. I'm just trying to educate you that this is part of the tech infrastructure that is happening and that it's moving forward. And this is not a tulip mania. This is a innovative, massive infrastructure change in how we're going to do business. One day we'll probably even have real estate on the blockchain. There's something that's called NFTs, non-fungible tokens, where maybe they'll sell the Empire State Building, where different buyers, including us, could own a piece of the Empire State Building. So what the blockchain and tokenization and NFTs are going to alter how we transact. And I know it's a little mind-bending. When I went into this myself, it was a little mind-bending. But it is what it is, and it's moving forward. So it's not necessarily, I'm telling you, you have to do it from an investment perspective, but understand it's going to have a significant impact. 10 years from now, the world will look very different, and how we operate will be extraordinarily different because of AI, blockchain, and robotics. Here's a chart of Bitcoin. It's extremely volatile. It goes up 100 to 80%, then goes down 180%. I would expect volatility to continue, but what you're seeing is even businesses now creating reserves of Bitcoin on their balance sheet. And when you look at how many Bitcoin have been created through the algorithm and who has been buying, there's been more buyers than what's actually been supplied in the marketplace. And one day, when all the Bitcoin has been created, I think there's a huge supply and demand imbalance. So if you're following this space, you're seeing astronomical price points in the millions of where Bitcoin is going. I say, take it step by step. Technically, I can get Bitcoin up to 150. We partner with Bitwise. Their forecast is 200,000. Right now, I see the bias to the upside, but eventually we'll have what's called a crypto winter. You'll go into a bear market. And generally, when you have a bear market, it is extremely painful. So understand that this asset is it's the most volatile asset I've ever seen. So in summary, we remain in a secular bull market. The economy is still growing. Earnings are still growing. You have higher earnings, you have higher stock prices. And all of this is being driven by innovation and new technology. And with that, I am happy, Brad, to take any questions.
Good. I should have said this at the front end. On your Q&A, if you want to raise your hand, or if you want to just type in a question, we'll get to it as quickly as we can. So Marianne, on going back to your Bitcoin and stable coins and such, it's exciting to think about it, but we're still limited on how we can really purchase and invest in those areas, right? I know the ETFs they're out there, but they don't necessarily track it equally. Some do better than others. How does the investor protect themselves from the bad omens and the players that are in this area?
Well, when you look at asset allocation models, I mean, the models wouldn't tell you to own a lot. They'd only get you into that 3 to 5% range on average, maybe the most 10%. And it is true in terms of if you want to put it in your portfolio, your only option that you have today are ETFs. But you can go out, we're partnering now with Bitwise, and they do have some fund management solutions where they can package part of the crypto space. I mean, if you want to do it individually, there's a couple of ways you can do it. They're called hot wallets and cold wallets. Let's do a cold wallet. A cold wallet is basically a USB port, I call it. And a company that does it is called Ledger. And you have to go up and go on an exchange. So you have to know where the exchanges are. You have to be willing to trade. You have to be able to transfer money from your bank into the exchange, go buy the crypto, and then save it on this little USB port. But your crypto's not on the USB port. Your password to the blockchain where the crypto is sitting is what you have. And there's no password recovery. And that's why individuals don't do it. You lose your USB port, it's gone. Unless you have that passcode is in your head. People that have put millions of dollars on these little cold wallets have placed them around the world in various different locations. So they have multiple backups. So most people are not going to do that. So how's another way you can do it? Well, Fidelity, you can buy crypto. Robinhood, you can buy crypto. You can get the app Coinbase and trade crypto. But they would have to do that on their own independently. And they wouldn't see it necessarily on their account. right now at Sanctuary, you do have the ability to purchase ETFs, and we do have two models. One model has both Bitcoin and Ethereum, and the other model has the crypto and some companies that are related in the space. I'll give you an example. Coinbase is a public company, right? So Coinbase trades very similar to the crypto market. There's a company, it was called MicroStrategy, it's now called Strategy, and they're basically now a treasury deposit of Bitcoin. They own a ton of Bitcoin on their balance sheet. Even though they're a software company, they trade like a more like Bitcoin on steroids would be a good example. So it's still very complicated, but I think as we get legislation from Congress, I think you're going to see better offerings be provided. You can also, in some ways, go to the private market. There's some way to invest in the crypto space. I'm not an expert. That's Patrick McGowan, but there are ways to do it in the private market as well.
Okay. Thank you. Thank you. Still waiting for a question or two. I've got one. I've got it. So let's talk about bonds. I mean, we go from one into, right? We have the bond aggregate finally showing some life this year, up 3.25% or so. But we got munis on the other side, negative, by 0.5%. Where's the disconnect there?
I know there's been a lot of supply in the muni market, and that could be part of the dislocation. I think there's been concern about inflation, right? We've had with tariffs and inflation. So there's still a lot of concern where bonds fit into a portfolio. But I think on the muni side, because most of the states have great balance sheets, and history shows that munis basically don't default. I mean, to find a muni that defaults is very, very rare. So I think it's been more of a concern. We've seen concern about the deficit. Inflation has really just impacted the bond market in general. But when you look at the muni market compared to the whole bond market, it's a pimple. The muni market's still a very tiny part of the overall bond market. And really, it's individual investors that really want the muni market because of the tax advantages that they get.
Yeah.
So it's not a bad space. It's not a bad space, especially if you pay taxes.
No, absolutely. It's just the returns have been less than stellar this year. So, all right. So we have one question that's kind of a general question, Mary Ann. It's what resources do all of you read to keep abreast of what is going on and to increase your learning? I would tell you mine more so these days is podcasts. I get a lot of information from podcasts late at night before, trying to sleep or whatever. It's a great way to soak in information without having to keep the lights on. What are you doing?
So if you want to follow the stock market, there's a paper and you can get it digitally that's called Investors Business Daily. And it's focused just solely on the stock market. So you can find out what companies are reporting, different news. They rank stocks based on their earnings and their price behavior. So if I really want to have a concentrated stock look, that's it only comes out on the weekends, so it's not daily. So it's easy. Get it every weekend and kind of breeze through that, and you can follow what's happening within the markets in general. They also do some ETFs and stuff like that, which I think is also very, very interesting. I read, it's interesting because when Warren Buffett is asked, what does he do? And Charlie Munger, when he was still alive, they're like, we read all the time. You're reading. Like I have Bloomberg. I have a news, a professional news system that I can read. So it's just about trying to podcasts, listening to podcasts. I get research from other places that I'm absorbing. So it's constantly reading something, but the podcasts are refreshing because you're not reading and you can do it anywhere.
And I will also tell you, there's a good monthly and quarterly report that you put out as well, that we put out to our clients. So, okay, this year we have a tax issues that are trying to be extended. Some of them are sunsetting. There's a question that says, what will be the effects on the market if Congress fails to renew the tax deductions of 2017?
I think you have a negative response and then you reverse right back again. Because again, it's corporate, you know, as long as companies are making money, the market's going to go up. So I think you could have an initial negative response, but I don't see a sustained response.
All right. That's it. That's it.
The only other thing that you need to watch out for market volatility, because it's part of the whole reconciliation, is the debt ceiling. And if we don't raise the debt ceiling, and we've done this before, markets go down and they can go down as much as 10%. And then eventually we raise the debt ceiling and the market comes right back again. So that's another factor that you'd want to watch is, you know, do they raise the debt ceiling? Because if they don't, the markets will not like that.
Okay. So to summarize, you think this summer there's a 5 to 7% pullback in here.
I think we can have a modest pullback and then break out to new highs.
Yeah. So so that should be a buying opportunity if we're cash on the sidelines. And then the new highs, and so I like it. I like it.
The
As
bull's
usual,
still charging. The bull's still charging. Hasn't stopped charging yet.
well,
You know,
Marion,
Kramer has a good line. Not that I'm the biggest fan of Kramer, but he does have a good line. There's a
What is
bull,
that?
you can always find a bull market. There's a bull market somewhere.
There
And
you
that
go.
is the truth.
Hence the pictures, right?
There's-
Well, I want to thank all our clients and friends that joined us today from across the country. I hope you were not disappointed. And of course, we want to hear from you, and we'll be talking to all of you in your reviews and upcoming events. So Marianne, thank you, and we'll see you soon.
Thanks for having me, Brad. Take care. Have a great summer.
Take care.